Ladies and gentlemen, welcome to today's online session. As we all know, the world has been in turmoil for a few years, yet the luxury industry, or many parts of it, are thriving. But what are the challenges ahead? Very happy to discuss with a renowned luxury expert today, Dr. Frank Müller. Welcome, Frank. Frank was the CEO of Glashütte SR, managing director of Lange & Söhne. He was a member of the extended management board of the Swatch Group and has subsequently founded the Bridge to Luxury, which is a boutique consultancy advising luxury brands all over the world. And in addition, he is academic director of our program in luxury management, an executive education program we're offering at the University of St. Gallen from this October in Paris and St. Gallen, Switzerland. It lasts 9 days, and of course we'd be happy if you want to know more after the webinar. So my name is Friederike Rieder. I'm at our university's Institute for Marketing and Customer Insight, and I'm responsible for our executive education portfolio. So before we dive right into it, please allow me a couple of remarks. We'll be recording this session and we'll send you the link to the slides as well as to the recording in the next few days, probably after Easter. So make sure to look out for that email. Also, I'm sure you're a curious audience and you've all brought your questions. Please post them in the F&A or Q&A section in your Zoom panel. You can just type them in there and we'll discuss them after the presentation. You can also upvote those questions you find most interesting or relevant. So please help me moderate that Q&A by upvoting those questions. And yeah, without further ado, I'd like to welcome Frank. Thank you for being here with us or being remotely with us and taking the time. And I wish you, yeah, a great next 30 to 45 minutes and an insightful lunch session.
Wonderful. Thank you very much, Friederike. I very much do welcome you today to today's webinar on the luxury industry and its 2023 outlook and beyond. Thank you for joining this session. With more than 200 registrations, we are thankful for your strong feedback. Indeed, I'm also very happy to see some customers of my consultancy firm, the Bridge to Luxury, in the audience. And I recognize some future participants of the program in luxury management here as well. Welcome, everybody. 3 initial remarks before we start. First, this is just a short webinar of 45 minutes only, including Q&A. Therefore, the presentation will not go too much into detail about particular markets or brands or product categories. It will rather provide a wider prognosis about the general global frame in which the industry will likely act in during the next 18 months to come. Second, the analysis thus is more macro-focused and number-based. It is not conclusive, yet in highlighting various snapshots, I hope to come to some logical conclusions for you. Thirdly, and finally, obviously, the current state of different product categories vary. The fashion industry is not the sports car industry, and there's a huge difference between the cruising business still being much affected by the COVID drama and, for instance, luxury watches, which do currently enjoy a strong consumer demand. So that's for the start. Now let's really get going, and I invite you to join me for the presentation, which I'm about to upload. And here we go. Currently, the luxury industry is in a strange situation. While the world is in turmoil, its affairs are seemingly doing well. To start this session with a little provocation, I have thought about the following Oh, I've got a technical issue here.
Try to click inside of the presentation to go on.
Now, okay, we do it this way. So I thought to start with a provocative thesis, which is some good current business numbers are misleading as the high challenges in the near and long-term luxury industry's future. That is sort of the leitmotif of this session, to make you aware that even though 22 was a super year for the industry, there are some important challenges laying ahead of us, and we rather try to be aware of them. Now, what is the program for this afternoon? After a short introduction, I would like to speak about the status and the outlook in 2023, some short-term recommendation based on that analysis, and the remaining time, I would like to focus on the longer perspective of the luxury industry. The luxury industry is a successful industry. Since 1990, the industry has enjoyed a very long cycle of strong and quite resilient business growth. It has been carried by three particular circumstances. First of all, new markets and internationalization, China, Russia, the Middle East. B, there were incremental revenues and margins through vertical integration along the value chain, buzzword brand boutiques. And then thirdly, or C, the online and logistics revolution, creating this phenomenon called home shopping. This led to an industry that for the last decade and even longer has been a stable one, and indeed a successful one, with an annual growth of some 6% above overall categories. And if we look in particular at the so-called high-end personal goods or hard luxury, since 94, the growth rate was indeed an astonishing 5.8%, despite regular crises such as 9/11, SARS, the Euro crisis, Lehman, China anti-corruption, COVID, or these days, the Ukraine war. Recap 22. This was a year of challenges of the world's economy. We had a war in the Ukraine, high inflation and higher interest rates, volatile exchange rates. China was on our mind. Oil and gas prices were up, thus affecting obviously economies around the world. We had the US-Sino relationships not getting any better, and the implosion of crypto bubble. Now, if one had wondered whether that would in a way affect the industry negatively, no, not really, because if we look at the numbers of last year, and these are stock listed companies, they're all positive. Without wanting to go too much into the details, what we see here, green means better numbers, red means worse numbers. And in terms of growth revenues, profit margins, whether it is at constant rates or real prices, it was a good year for the industry. And there were only few examples, individual cases such as Ferragamo or Bang & Olufsen, which underperformed. Overall, the industry enjoyed a rather good year. And that was the case with regard to all product categories, whether it was fashion, cars, jewelry, or watches. Obviously, a player like Norwegian Cruise, still being affected by COVID, could not match up to former numbers. But again, this is just an exception to the rule of a 22 relatively well, despite global challenges. 6 reasons. First, the Russian war had no direct major impact, except obviously for this topic of inflation. Supply of diamonds and gold was substituted by other countries. Pre-22, Russian luxury consumers did amount for some 3 to 6% of global spending. And to some degree, they still spend not in St. Petersburg or Moscow these days, but perhaps in Dubai or Ankara or elsewhere. Relatively weak euro lifted exports of the mostly Europe-based industry. Despite China's economic lock or slowdown, the world economy was further catching up with pre-COVID momentum, and the strongest driver, and we will come back to this issue again and again, were the US consumers. Just to give you some first numbers, in 22, Americans spent some 456 billion euros on luxury-related products and services that amounted of some 33% of global spending. In comparison, 2019, this number was at 279 billion euros. Fourthly, and that is important, there was early on time a shift of logistics away from China, necessarily so in some way, to the US and Europe. Therefore, if we have seen good sales in Europe and in the US last year, it was also because finally merchandise was available and could be consumed. 20 and 21, COVID excess savings and strong stock markets. And this would be an issue that I would like to explain later on as well again. And finally, groups like LVMH were able to leverage their business as they have been in the past. So those are 6 reasons, again, why the industry was doing quite well despite difficult circumstances. And if we look at the structure of the industry, it is still the same as it has been in recent years. The 2 major product categories or segments are cars and hard luxury, fashion, cameras, jewelry, watches. So these 2 categories, cars and hard luxury or personal luxury, amount for some 66% of the global luxury spending, and that has been the case more or less for the last 10 to 20 years. Now let's have a look at the industry status and the outlook for this year and to some degree 24. I would like to speak about 4 selective indicators or indications. A is the state of the global economy, the consumers universe, thirdly, the industry sphere, and finally, the investors evaluation. And these may help us with some snapshots to sort of formulate a global picture about what will happen till the end of this year and next year. So let's start with the global economy. The expected GDP growth for 23 and 24, well, what we have to likely accept is that the 2 major luxury countries will likely underperform, which are China and the US. In 19, both countries had, let's say, a regular growth rate, which we were used to. Now, if we look at the perspectives, China will fall behind 19 and the US as well. And there may be hope in India, yet that is still a developing market in terms of luxury and likely will not compensate this year and next year. So if we look at the overall performance of the economies, the 2 major markets, China and the US, which amount for more than half of the global luxury consumption, will not be as present as they have used to be. Second, hard luxury continues to align with the US economic overall outlooks. And that is an interesting phenomenon. What we see with certain product categories, they are correlated to certain other developments. So one is that the overall luxury industry is still strongly connected to the US well-being, economic well-being. And that can, for instance, be measured by the S&P 500, And if we look at the S&P 500 and the S&P Global Luxury indicator, then they are more or less aligned. So if we see that the US stock market goes down, we can expect that the shares for luxury players go down, and that is an indication what investors assess as future for the industry. There are other industries like the car industry for high-end cars that is strongly correlated to GDP world. So if we want to know how the industry, the high-end car industry will develop in the future, we can look at the numbers of the International Monetary Fund, and if they say GDP will grow, then the car industry will grow. If not, well, then the car industry will have an issue. And interestingly, the watch industry is also correlated to the GDP world, although here we need to distinguish two segments: the very high end, which is sort of outperforming GDP world, and the price category of watches between, let's say, 2,000 to 6,000 Swiss francs per unit will be strongly correlated to GDP world. What we see here as well, we likely cannot expect any major boost from China. At least it has not been priced in any of the indicators. So China, for the time being, at least for the next 18 months, is still a little bit on hold. And I shall come back to that topic as well later on. Now, and then we have fourthly, strong groups like LVMH, who simply follow their own orbit, more or less not correlated to anything. Being big, being professional, they take advantage of an outstanding growth and thus gaining market share in comparison to competitors. Now, still talking about the global economy, obviously one major thing we have to look at are the interest rates. And we have indeed witnessed a dramatic rise of rates within the last year, from basically 0 or 0.25% in the US to rates of 5% currently in the US and almost 4% in Europe. And obviously that affects households because their borrowing cost goes up, as well as borrowing costs for the industry. And obviously as well, higher costs of production that will lead to further public price increases and or company margin cuts. What we likely will not see is any big fall of interest rates, as the Fed and the European Central Bank seem to focus on the fight against inflation first, despite that we have a looming banking crisis. So with regard to interests, likely no super positive news to expect. Now, unemployment is so far not a big issue, which is also due because of government spend a lot of money on making sure that unemployment does not rise too much in helping companies to overcome crisis. And if we look at inflation here, we will see a certain decline, but likely a level that will remain relatively high over the next month. So here we cannot expect, and we will not expect any major positive or negative impulses for the luxury industry. Now let's change to the consumer's world. Obviously, inflation has an impact on the real life of consumers. And if we look here at the development of real wages, Q3 22 against Q3 21, there are happy countries like Switzerland where we do not have seen inflation, while there are major markets such as Italy, Germany, and Spain, where people have lost in real wages. So the thing is, and that explains to some degree a positive 22, consumers in general adapt to inflation with a time lag, curbing spending and raising savings. A decrease in real income is especially important with regard to middle classes, and that will affect the business of what I call prestige and luxury brands, especially with regard to accessories and perfumes and products that are not super expensive. And if we look at stock markets and crypto, these may melt away consumer spending potentials, which was one major driver in 22. So we have an issue with the development of income. If we see what is happening in various countries, we see strikes for higher wages that takes time to be negotiated. And until a customer or households feel the increase of wages, they may be cautious about future spending. And I'll come back to that point in a minute. The big hope for the luxury industry, excuse me if I'm coughing, but I'm still recovering from a COVID infection, so I'm not the freshest these days, but I hope you can read me. So the big hope for the luxury industry is a substantial COVID excess saving. And these are the numbers end of 22 in billions with regard to local currency. What are excess savings related to COVID? They were built up due to three reasons. First of all, reduced spending due to the lockdowns. Second, state subsidies to household to overcome a depressing period. And thirdly, strong stock markets in 21. So what we see here in the UK, for instance, there's a huge amount of savings that is waiting in the bank accounts of potential consumers. So that's in principle good news. However, only 40% of households have been able to save income by the end of 22. So it's a phenomenon that is more or less reserved to the top wealthy households in various countries. And it's the same phenomenon whether we are talking France, Germany, Italy, Spain, the UK, or the US. The poorer households used their potential excess saving to continue to serve their debt obligations, basically. So they couldn't afford in buying additional luxury items. This was more or less reserved, privileged for the top households, the top 40% households. Now, interestingly, the bad news is declining consumer confidence. And as we all know, luxury is a good moods business. And if there are no major motivating impacts short term, then maybe 22 numbers will come under pressure for this year. And in a recent study of PricewaterhouseCoopers being published in February 23, in their global study, having asked consumers, 53% of all consumers intend to decrease their luxury spending. And if we look at this chart, the war in Ukraine really has put again some pressure on consumers after some years of COVID issues. Now the war, and the mood is not really nice, except for the American market. And as I have said, I wanted to explain to you why the US was the strongest driver of the industry last year. Simply because the Americans are ready to melt their excess savings. In countries like the UK or Spain, Germany and France, people still keep their money in their accounts while the Americans are ready to spend. The issue for 23 and then 24 maybe that excess savings have been emptied, that inflation is high, that the stock market is volatile, and that finally as well in the US, the mood will shift towards a more cautious attitudes with regard to luxury spending. So that is really something that needs to be followed up in assessing this year and next year. Now, another hope may be the returning international tourism, and the UN is doing its forecast, and there's a positive scenario which will lead to an industry back to 19 by some -5%, and in the worst scenario it is -20%. It will all depend on the travelers bound for Asia, China opening up, Japan opening up again or having opened up, and then of course the Chinese and the Japanese traveling again. And so the potential is relatively high because in 22 Asia in terms of destination amounted only to 23% of 19 levels. So there is a potential. Now it all depends whether the Chinese will be traveling, whether the Japanese will be traveling, whether these markets will become attractive for tourism again. So it's a hope, yet we have to see how likely traveling will pick up and to what degree. Now, let's swap to the industry sphere, 2C, chapter 2C of this presentation. What is good news? Key commodities for the luxury industry get cheaper again, whether it is energy, whether it is gold and diamonds. To my point of view, I believe prices will remain stable or continue to fall, and this within usual price corridors. So this is to some degree good news. An issue, however, is the euro. 23, the euro took advantage of a weaker period, thus making exports to the world cheaper. That situation has changed to some degree. Some currencies have picked up again, except for the Swiss franc. So here we have to see how much importers, distributors, agents are ready and willing to buy products from Europe at higher rates. Good news, again, is the easing global supply chain pressure index. Slowly but surely, the supply chain industry is picking up again, so that we can all hope that what is needed to produce wonderful luxury products can be produced, because we have the materials for it, and therefore can offer completed products for our consumers. Now, finally, in the analysis for 23-24, which I always find interesting, are the developments at the stock exchange. And this is insofar interesting as a whole industry is analyzing the luxury players, the stock listed ones, and therefore it gives a good indication about what these investors, global investors, believe will happen in the near to longer future. Again, as I have tried to outline, the luxury investors continue to align expectations with the US economy, while the Chinese stock market still on cautious mode. So if we look at the development due to the war, there has been a shift in the expectations of investors, whether it is the US economy and therefore aligned to it, the luxury industry. In Europe, the outlook or the outlook is more pessimistic, and the same for Japan. So this gives us an indication that the fate of the luxury industry right now depends more or less fully on the US. Now, to continue with this aspect of investors' evaluations, what is also quite interesting is the impact of Tesla, and that is the lower part of this chart. We see how the proportion of market capitalization of cars has increased over the years, especially due to Tesla and its rise of stock price. Now, if we combine the market capitalization of the car industry and the three major groups, Hermes, Kering, LVMH, 73% of the total market capitalization is focused on these two segments. And if we exclude cars, within a few years only, the amount or the importance of the three major groups grew from 40%, and that's the upper chart, grew from 40% to over 50%, as a matter of fact, to 54%. So if we look at investors' confidence or interest or focus, it's quite clear it's the three major groups plus the cars. And that is interesting. It gives us an indication where these investors believe future growth will happen most likely. And it's interesting, still speaking about investors' evaluation, if who they consider strong, who were the top investments. Obviously, it was Tesla, Hermes, some smaller players like Cucinelli, LVMH. So most of them we would know. However, if we look at the development over the last 5 years, there are quite a range of brands or companies that, with regard to the stock markets, did not perform too well. So if we had invested money in Coty, we would have lost 8% on an annual basis in the last 5 years. Ferragamo, Movado. So what I'm trying to say here, and it is in line with this remark about the big groups and the car industry, luxury per se is not successful. Yes, indeed, quite a number of companies were able to perform well in 22. If we look at a 5 years perspective, at least with regard to some companies, there has been a tremendous doubt among investors pulling out money. Now, 23, after a year of challenges, 22, now one, I would say, a year of questions. Our hopes, China economy to rebound, less volatile exchange rates, stable and cheaper oil and gas prices, further improved global supply chains, stable employment, improving international tourism, freeing of excess savings as a potential. Question marks, US and Europe economies, looming banking crisis, the status of stock markets, real estate, crypto, the Russian war in Ukraine. And here, an interesting aspect that we need to consider as well, substitutional effects on offline, local, abroad. Local, abroad, for instance, if China has consumed locally for a while, now the same consumption simply may shift abroad to some extent. So we will not see, likely will not see local consumption in China picking up, and we add the tourism, the external consumption on top of it, there will be some substitutional effect that will affect, obviously, the overall growth rate of luxury in this year. Question marks, how much can certain governments continue to finance the crisis? This needs to be seen. Brexit is still on the agenda to some degree. And we have the risk, global consumer confidence, declining purchasing power, still high inflation, the US-Sino relationship. We all only wish that Sino-Taiwanese relationship will not lead to another war. We've seen recently national strikes in Germany and France, and the stronger euro is also a risk. Now, in assessing this year and next year, in weighing risk severity potentially and incident probability, I see more risk than I see opportunities. So my outlook for this year and next year is more pessimistic in comparison to 22. Overall, I believe the industry will grow by 5 to 7%. However, China will play an important part in catching up, thus lifting the whole industry up further. And we can ask about the consumers, the markets, and the channels, and obviously always the same number. And if I want to conclude this part of my presentation, the 23 growth will strongly depend on US consumers continuing to spend while Chinese shoppers return to former habits. I believe that these two scenarios are unlikely to fully materialize, and only by 24 there will be a return to some global pre-COVID normal if political circumstances permit. And then, however, there's a nice option of a rally due to the liquidations of COVID-related excess savings, and that will likely and especially be the case in Europe, in countries like the UK and Spain, Germany and France. So what are the short-term recommendations I would like to define for you? First of all, building up customer loyalty, one-to-one communication, intensifying customer retentionship programs. Second, product and service upgrading, rebalancing the channel mix to some degree back to wholesale to, well, take advantage of the classical capabilities of wholesale and to balance risk to some degree. Realistic, cautious revenue planning, purchasing and stock management, spreading risk, leveling of market presences, avoidance of discounts, avoidance of gray markets, and that is an issue that obviously this industry has known for decades. Securing supply chains, vertical integration, nearshoring, small batch production as a few buzzwords, actions on ESG while avoiding clean washing, because ESG will become a big issue in the years to come. And please start to prepare for long-term, your vision and strategy planning. Try to get out of the hamster wheel and focus on where you want to be with your businesses in 5 to 10 years' time. Now, given the time, I would skip this aspect of beyond 23. As Friederike has told you, obviously you will receive the slides, and if based on these slides you have questions, I'd be happy to speak with you and to feedback, so that we to take advantage of the remaining minutes for your Q&As, your questions, obviously.
Thank you so much, Frank, for your very insightful presentation and your detailed recommendations. We have a few questions in the chat already. Let's start with the very technical ones. Is the nominal growth of the growth rate of the luxury already cleared from the high inflation rates of the past years or year?
With regard to my numbers, the 5 to 7%, yes, are at current currency or current prices. Yes, cleared.
Excellent, thank you. And do you know when the Bain or the Gamma 2022 data will become available?
Historically, I think it's always November, December at the end of the year. I'm very happy for what Bain is doing for all of us. It's a wonderful source of information. Yet recently it was a little bit unfortunate. The war just happened, and thus I know the rise of interest rates and all that happened a little bit later. So Bain is currently. The oldest study is not up to date yet. I'm very convinced that when Bain publishes its half-year and full-year report, it will be as insightful as usual.
Thank you for that. Here a question from Thomas Wanka. The Swiss watch exports grow in volume, not in pieces. Is that similar to other luxury industries, or is there a difference?
To some degree, that's difficult to say. To some degree, first of all, we don't have those precise numbers in fashion. Obviously difficult to calculate the trillion of units and the global volume of the fashion industry. With regard to cars, to some degree, but here again, it depends on the brands. Overall, I would say the phenomenon that we are currently experiencing in the watch industry is particular.
Mm-hmm. And do you believe price increases in the luxury industry will drive the growth, or just pure volume?
No, this is one aspect I really would be cautious, given inflation, given the mood of the customers. Just looking from the consumer side, I don't think right now it's the moment to do it. Now, obviously, there are rising costs, so it's a matter of profits and margins as well. So what will happen, as usual, there will be a fight among who will pay the price. Is it the customer? Is it distribution partners? Is it the brand who will bite the dust? But I would be very careful in raising prices too much. I think, to my experience, customers appreciate brands that are not exaggerating and taking advantage of a difficult situation.
Thank you. Moving on to a bit of a marketing-related question. What are current marketing channels that are working for luxury service businesses? For example, it's an unusual kind of business, entertainment-driven, but we are struggling to find print publications that are effective for new growth. Do you have any thoughts on that?
I'm not sure whether I got the question. Sorry.
So it's really just asking what are the most effective marketing channels, or maybe new channels, new publication outlets.
For which industry?
It doesn't say here. So Daniel, please feel free to add on to your question here in the Q&A section. So maybe we can, for now, move on to other questions. Let me briefly scroll through the chats. So what are your thoughts, Frank, about the BRICS replacing the US dollars for trade effects? Yeah, do you have any thoughts if
no,
BRICS will play a larger role?
No, I'm sorry, not really.
And there's a follow-up question. What's your opinion regarding India as a new promising luxury market? Is it promising?
Well, it has been a promise for the last decades, and obviously it is evolving. You have the ultra high net worth income consumers, and obviously there is a group of extreme wealthy people that is spending mainly abroad, obviously also in India, but mainly abroad. And then you have a growing middle class. Yet what we haven't seen yet is such a strong development as we have seen it formerly in China. So it is still, I think, on our list of hopes, and it is evolving, but before it turns into an important market such as China, the US, or France, I believe there will be another decade to wait for.
Mm-hmm. And regarding the brands and companies, do you see any bigger M&A activities in the industry on the horizon?
Just recently there were talk of the town was LVMH considering acquiring Richemont. There's always potential for M&A. The groups I think are always looking, yet the size of the group has turned so big, and the number of brands, it remains to be seen whether Kering needs another fashion brand. They have just de-invested away from watches. LVMH has 3 brands. It may be watch brands. It may be a quite complex game in adding some 10 Richemont brands. I believe there's always analysis going on, but I don't see any major things coming up for the time being.
Well, thank you, Frank, for all your very insightful remarks. I think we've reached our time limit, more or less. So thank you very much for taking the time, and thank you, dear viewers and listeners, for taking your time over the lunch. And yeah, I would like to remind you, please look out for our follow-up email. Will take a few days, but we'll send you the slides and also the link to the recording. For any other follow-up questions, of course, feel free to reach out to us through LinkedIn or email. And yeah, please stay connected through LinkedIn perhaps, and check out our program in luxury management. We'll send along further information about that as well. Do you have any finalizing remarks, Frank?
No, just from my side as well, thank you for your patience and having been with us today. I'm sorry, again, not the freshest moment in my life, but I hope once you have received the slides, you can go through them and look into them more in detail. So once again, thank you very much. I wish you a pleasant afternoon and hope to see you soon again. Thank you very much.
Well, thank you, everyone, and happy Easter. Bye-bye.